Hey everybody, hey traders, Chris Moore here. It is around 2:45 p.m. on Tuesday, September 23rd. A little bit of a market update. We had a couple levels that I wanted to point out. If you watched my video during FOMC or leading into FOMC, I was pretty spot on with the noise and the indecision candle. So what we ended up having was a very noisy FOMC and a bit of a nothing burger. The market highly anticipated the rate cut. It got it. The market did sell off with some of the comments that Powell had, but quickly came back in to close just barely red for the day, and then gapped higher aggressively on Thursday, Friday, and then yesterday, Monday, was a pretty big rip for a Monday. I usually don't see a lot of directions on Monday, and we got a big one to the upside. Now, I'm taking a look at the technicals, and it was pretty straightforward. When you take the measurement of the FOMC candle, and you look at a breakout either going down 100% or you look at a breakout going up about 100%, it worked out to the upside. So going long to that 100% breakout was pretty awesome. And now looking to, what I've been positioning for these last couple of weeks is as this breakout happened through the Fed, I was positioning for 6750, 6800, 6850. I've got a bunch of broken wing butterflies in the SPX that as long as price can stay below 6750 or 6800 by the end of this quarter, which is next Tuesday, or by October 3rd, which is a non-farm payroll day, I'm hoping that we are going to see some bit of technical weakness in the market just to come back into a 21 period or a 50 period moving average. Candlestick formation wise, right at the top of this breakout today looks like we are forming either a dark cloud on the SPX or a engulfing bearish candle. And now the question is there follow through? This might be a indecision zone where the market doesn't do anything and then it takes a little bit more time to roll over, or it just fights inside of it and then just proceeds to go higher in this zombie melts up market. What I did notice today, at least in the short term, is that we have gone into a negative gamma environment for the day. So if this continues, this would be where puts might get a little bit more expensive. This might force some dealer flows to be buying puts and going with this to hedge to the downside. If we get back above 6670, we're right back into the zombie market environment. If we get below, which we are now below 6670, and we start heading lower with negative gamma, that is going to possibly be this cascade where there's not much protection to the downside. We might see the market quickly come back down to these FOMC lows. That is 65.51. There's also a monster gamma pin in the options market at 6,500 with a JP Morgan collar trade. So I wouldn't be terribly surprised if by the end of the month, which is not that far away, that's literally less than a week away, okay? Next Tuesday is the 30th. That's going to be the end of the month, end of the quarter. If we are coming back down to at least try to get to 6,550 or 6,500, that could offer a decent level of support. But I still make my argument that this market has stretched a long ways away from the 21 period moving average, and mostly I'm watching the stretch away from the 50 period moving average. It is not only in time, but also distance. The last time we were this high above it, we had a 3.3% correction on July 31st to August 1st. The last time we actually tested this level, we were sitting here. We're above the 50-day right here. And that stretches out about 90. Actually, no, now it's 100 bars. Wow. So right at about 100 bars. The last time we tested this would be a touch of the 50 period right here. And we're talking about 95 bars. That is a lot. There have been more times at higher bar counts. We've seen a 102, a 105, a 112, and a 128. That goes back, 30 plus years, 40 plus years. So it's not very often that we get and move that far away. But what I noticed is if you go back in time and look to see how many points higher we are, rarely are we 250 to 300 points higher. And right here, when we had this big pullback, this market was about 280 points higher than the 50 period. It's about 280 points. We had a nasty 3+% correction. This push up into the FOMC breakout candle is pushing up into like the 270s. And again, I was kind of calling the market's bluff, at least in the short term. If we pull back to this level, we're 270 points away. I'm not saying it can't go higher, but it seems like at least a pause, at least a pullback, maybe not breaching 6,700, 6,750 by the end of the month, end of the quarter. And if we do make a follow-through run with some of this negative gamma, this could continue to perpetuate a cascade to the downside, which maybe comes back and fills this gap post FOMC, possibly comes back into FOMC lows and gives that JP Morgan collar trade and gamma pin around 6,500 a chance to get hit. So in the near term, that's what I'm looking for. This could all be pointless if we're back above 66.70 by the end of today. So I'm doing this video before Tuesday's close. If we stay here below 66.70 and futures market starts to unravel a little bit overnight, we might come into a gap lower on Wednesday. This might continue to be, more weakness, more selling off. It might drive some traders crazy, like, what the heck just happened? I just bought at all-time highs, right? But technically, this market was overdue, and we're finally getting it. I'm hoping that's the case. Look, I want to position for dips. I'm still happy to buy the dips. I'm just looking for dips to be down here. Well, that's a little exaggerated. I would say between the 50, the 100, the 144, the 200, the deeper, the better. But if it's a flush down, pullback, flush down, and then we look to kind of trough this thing out, I just want to see if we can find some dynamic support. So I'm still in the belief that we have like a 3-5% correction. If it gets a little bit more volatile, maybe into the 7, 8, 10% corrections, that puts us right around that 200-day moving average. So this is exponential moving average that I'm using. If we go down from all-time highs here, that is around a 9.7% correction. That's a pretty big sell-off. And could it happen in 30 days? Sure. Could we get a pushback down towards this 50-day? Sure. Does the market immediately snap up the dip and go to all-time highs? Maybe. But the VIX had an interesting couple of weeks because we were building up the VIX into that VIX expiration last week. We had FOMC, and there was a complete reset of the VIX on Thursday, and then the market proceeded to go higher, higher, higher. But the VIX is going higher along with higher highs. So we are now increasing volatility day to day. If you're at a 17 VIX, that is not low volatility. Okay, I mean 20 plus is considered high volatility, but 17 is not a low volatility environment. We have been at 15 and sub 15, and that's been this like low melt up zombie market to the upside. But if we're getting VIX at 17, another step above that is 18, 19, 20 plus. I'm in the camp of looking for the market to pull back and looking to sell some premium, because that should offer up, hopefully some high premiums. Put protection, which I do have. I mean, if it's offering me some short-term protection, great. Otherwise, it's just be in position for out of the money puts, ratio spreads, some 1-1-1s, 1-1-1-1s, things like that. Just generate income safely. And I think the market's still going to stabilize and still be trying to push towards all-time highs by the end of the year. I think the market's still pretty safe and bullish and resilient by the end of the year, but it's not without the threat of a correction. And I'm hoping that we're getting it now. This is the first time in literally a week or two that I've seen negative gamma on a day-to-day basis. So if it stays here, and this is a flush lower, a pause, and another flush lower, if futures takes us down to fresh lows and we open up on Wednesday pushing lower, I think we make a really good run at this gap level here. And possibly if we fill this gap, we might come back to this FOMC low. There is that gamma pin at 6,500. It doesn't mean it has to get there. This is a pretty valiant effort. If the market goes from 67 down to 65 in a week, that's a pretty good sell-off, right? If we go from 6,700 highs all the way down here to this FOMC level, I mean, that's a 2% sell-off. That's higher highs for the week and also testing the lows from last week. I mean, that's pretty respectable. Does it go lower than that? Nah, we'll see. I mean, this trend line is still supported. If you go back a little bit further, go out to the 30-minute time frame. I mean, you can go back to the start here with our U.S.-China trade agreement gap. The first pullback we had in May, there's a lot of support here. So unless that support is going to break, unless we're coming back into previous all-time highs at 61.45, I mean, again, we can get there, but I'm happy to scoop up some buying opportunities and scoop up some dips. I'm just hoping that we finally get a chance for this market to roll over a little bit and start making some sense to some of us technicians out there that are like, I cannot believe it's gone this long and far and high above the 50-day moving average, and let's see if we get a bit of a rollover, especially after we had inflation and after we had the Fed and the market proceeded to just keep going to all-time highs. One thing I noted last week in my videos is I highlighted that the AAII sentiment had a big pop in bullish sentiment for the first time in months. So we finally started to see that the bulls were like 28% bullish, and now they jumped up to like 41, 42%. The bears decreased by about 7%, and the neutral party jumped into the bull camp. So we saw a pretty big shift in sentiment last week at all-time highs, and it's like it finally convinced anyone that's been on the fence to jump in and buy the markets. So that's just the SPX outlook, but that's the broader market. If the SPX goes down, we're probably dragging the Qs with it. They look very similar, right? So NASDAQ Same thing. I mean, we have not had a retest of this 50-day since May. There was a little test, but it didn't technically. This is an EMA. It didn't technically hit it, so I don't count that as a hit. I know it's close, but it looks very much the same. So is this a engulfing candle at the high? Is this a dark cloud cover? Yes, no, maybe so. But if there's some follow through, do we pull back to the 21 period? Do we pull back to the 50-day? Is there a pullback even into this past resistance level that can become support? All this is offering is dynamic support. That's all it's offering. So back up the truck. I like the scooping up some profits here. I like the scooping up of some credit spreads or some deployment of capital, but just hopefully getting a decent pullback. The Dow, also very similar. Do we pull back in some dynamic support? The Russell, do we pull back into dynamic support? I'm hoping this is the case for all these things. Just give us a pullback and I'll position accordingly. We go dollar, gold, silver. Dollar, I did plan on the dollar catching a bid at the lows here. We were just kind of slowly working our way lower. As we came into FOMC, I thought this is a fake out on the dollar. This to me is a bear trap. I could see the dollar catching a bit of a bid, especially if you have a risk-off environment in the stock market, at least in the short term. If the dollar catches a bit of a bid to the upside, and then you can come up here and then fade the dollar for a more secular bear market in maybe the next like 60 to 90 days. But if we have a dollar bid, we'll see if things go up a little bit higher. Oil, pretty strong support here around 61. I need my oil prices to stay above 50 in futures to make some money there. I've got to trade in with a 1111. Gold and silver. Gold, I just got filled on a trade today. It was a trade that I posted like 30 days ago. I ended up taking it off for like a $20 winner because I'm like, why am I calling the top? I did a call condor trade on gold futures, which was basically I give myself a profit trap. It was I get credit, I have a profit trap, and then I have risk. But the way I got filled on the trade was it was all the way up here where price just has to go like 20 to 30 points higher. Then I have my profit trap. Like, well, in the next, this was an expiration for 9:30, so next Tuesday. And if price just goes boop, then I risk $800. So I took the $20 profit and I just called it a day, and I'm not going to flirt with this thing. Meanwhile, I'm just setting in dollar cost averaging levels on GLD and gold futures. If we can get dips, I'm looking to go long on gold futures. Any dips would be great. Any dips. I'm happy to buy any of these dynamic support levels on gold. GLD, same thing. All of these support levels. Silver, all of these support levels. SLV, all of these support levels. I just put dollar cost average levels in on my margin accounts. I went $2,000, $2,000, $2,000, $2,000, $2,000. So I'm looking to allocate more. I have shares of SLV. I have shares of GLD. I'm looking to allocate. Okay, Bitcoin is pulling back and actually, underperforming. Bitcoin Bitcoin is underperforming gold and silver at this time. For now, I guess. MicroStrategy, I just think there's a lot of engineering going on here. There's a lot of volatility suppression on Bitcoin. The yield stuff that's happening where it's like there's ETFs and recovered call strategies. They're trying to put in a cap to the upside. They're trying to put in a floor in. I don't know. It's financial engineering. I'm not saying it's a bad thing. I'm just saying that it is not letting Bitcoin really trade kind of freely with risk on, risk off. I'm hoping that as this cut cycle takes hold further, and we got like a second and third cut for the year, that we start to see a weakening dollar once again, and Bitcoin starts to get a rally. If we continue to see risk appetite, then Bitcoin can run and hopefully squeeze through some of these covered calls and all the volatility suppression that it's experiencing. Ethereum, I'll wait for a pullback there. Coinbase, nothing. Copper, I looked at some trades on copper to get below these April lows. I just don't like the reward to risk. I think copper is still going to be heading up into this like crazy distorted gap. This is a massive weekly candle that was on the tariff announcement. It's been crazy volatile, but I think there's a pretty safe low below this April level. Japanese yen, I want to say I've got a good trade lineup on the Japanese yen, but it's just not ready yet. This whole idea of the Bank of Japan raising rates while the world is cutting rates, this might be revisiting a slight deleveraging of the Japanese yen and maybe seeing this carry trade unwind, but I don't think it's going to be the same magnitude as what we saw in 2024. DAX just off all-time highs, FTSE just off all-time highs. Some things that are outperforming the U.S., China, Brazil's actually up to some fresh highs. I've been in this thing for a while since basically COVID levels and revisiting COVID levels in 2024. I've been long EWZ. I'm also long ILF. That's Latin American exposure. I think these trade negotiations, if we can't get everything we want from China, then looking at our northern and southern neighbors to play a little bit more into this side of the hemisphere with what we can do business wise with them and trade wise with them. Mags, overbought conditions. Another one that looks very much like the QQQ or the SPY. pulling back into the 21 or 50 period moving average, pulling back into the previous all-time highs. If MAGS follows to the downside, we all know the market's going to drop with it. If we have, I mean, literally the market was up on Monday because Apple and Nvidia were higher. Now we have MAG 7 showing red, and it's dragging the index is down with it. Okay, Apple just off of these recent highs. Amazon selling off pretty aggressively today. Broadcom, this is down a little bit off those crazy gap highs. Google probably coming back to fill some gaps. Meta just off all-time highs. Microsoft, post earnings exhaustion gap down about 13%. Fighting back, but I'd still like to see a bigger pullback in these moving averages. Netflix, I want to see a 200 pullback. That's a 200 moving average. Nvidia, I did a ratio spread today at the 100 by 95 or the 105 by 100. I'm happy to take more shares. I got filled for $1.30 credit. I've got some more trades in here for Nvidia. That's like a 140, 130, 120. Just looking to sell some puts on Nvidia for right now. Tesla, I still like it. Obviously it's down today, but this is a huge ramp to the upside. I think we've broken all this good structure. Now I'm looking for Tesla to have a higher price target in the 500s. If we get any pullbacks here, maybe a bull flag, maybe a pullback into 370. 350 zone offers some pretty strong support. See if this will offer a nice technical 1, 2, 3. Let's say this is wave 1, 2, 3. If it just pauses here, look for a 5. Okay, if it's more symmetrical, something like this, draw a trend line, look for trend line past support or past resistance becoming support, and then we can look to establish some longs to get back to all-time highs and hopefully a boost higher. Okay. What else? Berkshire, meh. And bonds, let's take a look at TLT. I did exit my position on TLT. I was up here into the 89.90 zone. I got out for about 85% of my max credit on a diagonal spread, which I was pretty happy with. I'm now taking those profits and allocating more to gold and silver. The US 10-year, we did have a nice little chunk to the downside. The Fed has been cutting rates. So far, we haven't seen a big change in the 10-year. So I don't know if the market was expecting, the 10-year should be falling aggressively because the Fed's going to cut. Well, it hasn't happened yet. At the same time, the 10-year hasn't been ripping higher like it did back in September of last year, and that kind of remains to be seen. Are we going to see October, November with higher yields? Or are we going to see October, November with, sideways? TBT. That's to be determined. Okay, so I'll find out. But I'm watching, and I think that's something we have to pay attention to as far as risk on, risk off. It's a big disappointment if yields rise. It's a big disappointment because it's not improving the longer-term borrowing costs. It's not improving the long end of the curve. Look, the government can declare a national emergency. It doesn't necessarily mean that the bond market and bond yields are going to change. So the long end of the curve, short end of the curve, all this stuff is up for grabs right now. But what it is doing is it's showing that there is stress in the bond market because less and less flows are coming in to buy and hold long-term bonds. Short-term bonds, very different. Short-term bonds are flush because everyone wants short-term bonds because we have some of the highest yields and most stable markets in the world. But long-term bonds, I think is showing that it is to use a metaphor, kind of the melting ice cube of they're going to be worth less with the debasement of our currency. If we're losing purchasing power debasing our currency, I mean, what good is holding something that's backing fiat versus holding something like gold or silver or Bitcoin that's backing something else that stands for something else? So anyway, this is something to keep an eye out for, but gold, silver, Bitcoin is a good way to hedge that. Being long assets, good way to hedge that. Stay long the S&P, just looking at dips, understanding that short term we could have some corrections along the way. Mortgages have come down a decent amount. This is 30-year fixed down to 6.26. That's a pretty good improvement. I'm curious if we can get below a sub 6. Maybe that increases some housing activity. That is enough to move the needle in the economy. But again, to be determined, whether or not we are going to see the 10-year yields go higher or lower will dictate whether or not the mortgage rates come down further or start to stay sticky around the 6.25 zone. Currency-wise, I'm just going to go DXY again. I think the DXY and the Japanese yen, so dollar index and the Japanese basket, I think those are the two currencies I'm watching the closest. Right now, I think that the dollar, if we catch a bit of a short-term bid to the upside, dollar catches a bid here, stop losses right below these lows. If the dollar catches a bid, I think that's a risk-off trade for the stock market, at least in the short term. Okay, if the dollar continues to slide lower, 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 then this like positive gamma reinforcement zombie market loop of like just buy every single dip, everything that's down 0.5%, 1%, buy the dip, buy the dip. It just reinforces itself over and over again, especially in zero DT flows. This is what I've seen a lot of in the markets. So based on today's close, it looks like we are going to see a nice dark cloud candle or possibly an engulfing candle, but I want to keep a close eye on this. I'd say this is more of a dark cloud. if we see follow through here, the futures market for Tuesday to Wednesday will be really important to watch and see where Wednesday opens in the US. Because if we open lower and proceed with lower prices and also negative gamma, I think that is that feedback loop that gets us back into this gap fill, possibly the 65.50 lows from FOMC, and maybe getting closer and closer to that gamma pin at 6,500. So it comes full circle to that. All right, that's my time. Thanks for watching, and see you in live markets. Take care, bye.